Thanks for your company on this 6th day of February. My name is Jessica Ramir, a market strategist here with Moomoo. Thanks for joining me. So the tech sell-off is continuing and it's pushing down global markets. In the US, we have seen the Nasdaq-100, the biggest loser there, losing 1.4% overnight. It's now down 6% from its high, hitting 24,548. We're going to cover the key levels that you need to watch later in this update. Meanwhile, the broader S&P 500 is now down 3% from its high, but the thinking is we could be near maybe correction territory soon. That's what's on the minds of some traders. Meanwhile, if we think about our Aussie market, it's down 2.5% and it faces pressure today. Our market down 2.5% pretty much echoes the pullback that we're seeing in Europe. Their benchmark index also down by a similar magnitude. Basically, we are seeing their market, if you are in that European benchmark index, consider that they recently flagged an ominous technical signal recently called a double top that suggests further downside. Meanwhile, Bitcoin, that's looking to be like a bit of a doozy. Bitcoin's pullback is continuing. It's now below 65,000 US dollars. The next major support level that you probably should be watching is 60,000 US dollars. Then the 200 moving day average is into question. Then maybe you could be questioning if Bitcoin gets back to around 56,000. But you have to consider every time that we speak about Bitcoin pulling back, you need to remember why it's being pressured is obviously because of the fundamentals. But secondly, you've got some people being forced to sell Bitcoin positions because many took out leveraged loans. So some are basically being forced to kind of scramble to sell stocks that they have profits on, vis-a-vis they're selling tech stocks to basically cover their Bitcoin losses that they've got margin loans of. Across other markets, you need to consider that commodities are also down very sharply. Silver is down 19%, almost like a meme-like reversal. Gold also copping it a big punch down there, 4%, but we're going to cover what you need to be across later in the bulletin. Obviously, the futures are suggesting a negative day across Asian markets, while gas stocks may be a bright spark with gas prices pushing up 1.3%. Pleasing to see because it's been a sea of red across most screens today. So what's going on? What do you do? Do you white knuckle it? Do you buy the dip? Do you hold? Now, these are the questions that you probably seriously need to consider asking yourself here. But remember, you and I have been doing this dance for a little while now. We've chatted about this many times. The Nasdaq-100, the S&P 500 and the Aussie share market, they pull back and then they recover. But the lay of the land right now is what happened overnight is we are seeing a little bit more concerns rise to the top, suggesting we could see more downside for the major indices. So what happened? Well, we are seeing rising jobless claims in the US. This is basically adding fuel to the fire, suggesting the US economy, hey, it's actually probably slowing. So this is adding downward compression pressure for tech stocks to be re-rated. And we know tech stocks, think software, seriously being questioned. We've spoken a lot about, I guess, an influx of new other AI models being released, and this could all disrupt the overall software sector. What we're learning now is that some software companies might not make it. They might not recover from this, while the largest software companies, they'll probably have to have, a show me the money moment, as Jerry Maguire said. We just need to see if they can come out stronger. For more on software, you can check out our video that we did on that. But what you need to know and consider is this. Now, regardless of what software company makes it or doesn't, the major indices are probably going to still be there. That is a serious consideration. They're just right now adjusting lower before likely resuming a rebound. And as I've said before, we've seen this for the Nasdaq-100, the S&P 500, and the ASX 200. They have always recovered from market crashes in the past. But now the serious question is this. You need to consider that many people in the sophisticated part of town are questioning the bull market that we've had over the past 3 years. Many are questioning that bubble. You could say a bubble. It's actually being questioned if that's potentially going to be burst. So you really need to think about your approach here. So I want to cover what I'm watching, and I want you to add to this, or consider adding this to your repertoire. Now, the first thing is obviously the Nasdaq-100. If weakness in the Nasdaq-100 continues and the index falls under the 24,500 level, and then it hits, say, 24,000, then you might expect dip buys to potentially show up. But if the software AI anxiety sell-off continues and the index falls under the next key level that I'm watching, which is the 200-day moving average, that's around 23,700. So just bear with me. So if it falls below this level, it would be probably an uh-oh moment and could signal a major shift. We could be moving from a healthy correction to a broader deterioration, and this would likely force further selling across growth stocks and tech stocks. So that's what you need to consider. So what do you do now? Well, let me tell you what I'm also seeing to kind of like build out this argument. What I'm saying is investors are actually taking profits, obviously, from tech stocks that are being questioned here, and they're using the profits to basically rotate and buy into boring sectors of the market, staples, healthcare. And remember, we usually speak about this happening, as it always does, in typical times of economic uncertainty, when the economy is kind of sputtering along. So how do you kind of like show this if you were to look at a chart? Well, if you look at the Aussie tech sector, and look at that over the last 5 days, you can see it's down almost 11%. So clearly, investors down under here are selling out of tech stocks or taking profits, and they're buying at exactly the same time, they're buying US consumer staple stocks. So if you have a look at some consumer staple stocks, they're making gains as steep as the Centrepoint Tower. They're going up vertical. The US consumer staples sector is up 6.1% in 5 days. Stocks like Hershey's, yes, Hershey's are up 18%. Pepsi, Colgate also up 11%. That's a consideration. If you want to rotate out of tech and go into staples, that's up to you. But here's the other thing that I'm watching, the VIX. So you can track this on Moomoo just by typing in VIX. This is the market's fear and greed index. So the VIX index overnight hit a level of 22. That's the highest it's been since November last year. This basically shows us that, yes, there is fear in the market, but what the VIX represents, what you need to know, is it basically represents sophisticated investors. When it goes higher, it shows you that sophisticated investors are betting the market could fall further. So that's what you need to consider. Sophisticated investors are betting that the market could fall further. So keep that on your radar. But for you, perhaps you might like to just slow down, look at the fundamentals, look at companies that you maybe think you want to own a year from now, 5 years from now, 10 years from now. So with that lens, that really enables a lot of investors to kind of look past what's happening week to week, month to month, quarter on quarter. But you can only really put on these lenses, obviously, if you're a long-term investor. Traders simply won't do that, but that's might be a personality thing. But what we are seeing next that I want you to consider is what we're seeing Moomoo traders and investors do on our platform. Well, they are buying the dip. Over the last couple of days, we've seen lots of buying in AMD, Microsoft, Palantir, and Micron. And as always, there's lots of buys in the very popular stocks that are Nvidia and Tesla. So if you don't want to do that, if you don't want to look at potentially buying the dip, that's completely up to you. Maybe you're waiting for a couple of days, maybe you're waiting for a couple of weeks, I don't know. But if you did want to consider buying in, if that's something that you want to do, you could consider dollar cost averaging in. But maybe you might like to take an index approach, given what I've said about the S&P 500. Think about the S&P 500, right? If you did start buying into that dollar cost averaging in, why would you buy in? Well, the S&P 500 is actually producing earnings growth of 14% year on year. Or you could look at buying into or dollar cost averaging into the Aussie resources mining sector. Why? Well, that's got phenomenal earnings growth, so far producing 300% earnings growth year on year, eclipsing anything that you could see anywhere. But maybe just maybe you look at the Nasdaq-100. So I'd like to bring up the QQQ. This is one of the most bought tech ETFs in the world, but I suspect many may be looking to start to buy this because this obviously tracks the Nasdaq-100, and the Nasdaq-100 is producing earnings growth of 17% year on year. We know about half of the Nasdaq-100 companies have reported so far, but they are delivering 17% earnings growth. So this suggests, remember, earnings growth drives share price growth. If you take a long-term view, you could consider maybe buying into that if that's something that you want to do. But let's just cover one of the Nasdaq-100 companies that reported results after the market closed, and that was Amazon. Yesterday, we spoke about Google or Alphabet. Today, it's Amazon. So tough crowd for tech. So their shares are down 9% in after-hours trade. Before we recorded this, 9%, very sharp sell-off. And this continues to be the pattern. Any company that is delivering results that are weaker than expected or announcing huge spending plans in AI, investors are kind of starting to go, this is kind of a bit of a worry because expenses are now rising too fast, too quick, and they're rising more than expected. That's kind of what investors are processing while markets are readjusting lower. So Amazon plans to spend $200 billion on data centers, AI chips, robotics, and low Earth orbit satellites. So it's great if you are investing in this company for a long-term view, but it's not really good if you're seeing their shares down 9% in after-hours trade. And the technical indicators do suggest there could be more downside for Amazon. But the fact is they're spending 200 mil on AI. That's more than Alphabet's upper limit of 185 bill that they announced yesterday. But both Alphabet and Amazon's numbers, yes, they're above expectations. And Amazon's quarterly numbers also missed the mark. And that's probably why a tenth of the company's market value was wiped out post-market. But if you are taking a long-term view, I guess you could take comfort in the fact that it does have a strong buy rating on Moomoo's platform. Amazon recently reiterated as a buy by UBS, and price targets, if you do have a look at those on our platform, they range from $250 to $340. And bearing in mind it closed at 223. Last but definitely not least, we spoke about gold pulling back as well. GLD is the world's biggest gold ETF, but another ETF to watch is this one we're bringing into the fold. Now, the Global X Physical Gold Structured ETF, basically the same thing, but this one's listed here down under. This is a pretty popular way to trade gold. It essentially tracks the gold price, and it's physically backed by gold that's held in vaults by JP Morgan in London. So whenever gold goes up, down, this ETF basically tracks that. So this ETF is being pressured, obviously, with the pullback in gold that happened yesterday and today. But I would encourage you to think about that gold will probably be bought because it's recommended by advisors across the world because gold typically, depending on what type of investor you are, if you're a balanced investor, gold may sometimes account for 5% of an investor's total balance portfolio. And gold ETFs like this are an easy way for some investors to buy gold. But if you do have a look at gold, gold is actually still doing pretty well despite the pullback yesterday and today. Gold is up 10% this year, and the ETF that we've got on the screen somewhat mirrors that. This ETF also doing really well across the 12 months. It's up 52%. But now, with gold well under 5,000, this morning it was at 4,779. The question is, how low will gold go? Well, gold might face further selling short-term pressure here, I suspect, but do remember that there are bullish calls in the market for gold to get to 5,500 or 6,600, depending on what investment bank you look at. There are many bullish calls out there for gold. So Unless you are a trader, maybe you wouldn't be looking at this ETF, but if you are a long-term investor, maybe you could be thinking about long-term upside potential and maybe, just maybe, buying here.